Margin and leverage. They are among the most complex terms when used in Forex and CFD trading. And when they are understood, your trading will become easier and you will begin to grasp the importance of risk management. The terms margin trading and leveraged investments are sometimes confused. While different in real terms, a trader should know they are closely related too. In trading, margin is simply another word for collateral, which simply equates into the amount of money you must have on deposit so the broker will give you a loan, just like a bank when you're taking out a home loan. It is hard to get a loan to buy a house without having something to put up as collateral, meaning you are bringing something of value to lose if you can't pay back the broker or bank. In its simplest form, trading on margin means that an investor borrows money to trade on an asset, and the margin is the money the investor himself must provide to cover potential losses. Margin is expressed as a monetary requirement. For a $10,000 investment, using a leverage level of 1 to 50, the margin requirement would be $200. Notice please that margin requirements on different assets and/or asset classes may differ. Usually required margin will equal the bid or ask price of an asset multiplied by your lot size multiplied by your leverage ratio. Leverage is the level by which a broker will multiply your investment via risk money they are willing to extend to you. This so you can make greater profit. In a tight Forex market, profits may not be more than a couple of cents either way. By extending your leverage, for example with a ratio of 1 to 50, the larger number represents the broker's risks and the smaller one, the trader's. If a trader opens a position using a 1 to 50 ratio of leverage, for every dollar he invests, the broker invests 50, thus multiplying the profit by 50 times. So, an investment using a 1 to 50 level of leverage would allow a trader to put a position of $10,000 for a value of $200 of required opening margin for the trade. Now, let's say we had a $100 balance in our account before opening the position. That number would immediately begin to change based on the position's value as it trades. Our balance is no longer $100, but rather plus or minus our potential results of the trade. And as long as you are in the money, your equity will rise. And if the position begins to lose, your equity will show a decrease in value. So it must be understood. Margin level is also part of your equity dedicated to all your open positions at any given moment. And the amount changes for each additional position opened because a certain level of margin is required, which is called margin requirement. One's margin level is simply the percentage derived from dividing existence equity by the amount of margin currently in use. Importantly, your margin is in constant flux, based on profits and losses per your open trades. So always make sure your equity is properly above your margin level. You need to understand your broker will require you to maintain a certain level of margin. If the amount of margin in your account falls below the required percentage your broker mandates, your trades will be closed automatically by their platform. That is why it is important to maintain proper margin to keep your trades alive until you no longer want them active. Most platforms will provide a margin call, an alert that is set to warn traders of an impending stop out once your margin level hits a certain percentage of your equity. For some accounts, your margin call will be set at 100%, meaning that you will receive an alert the moment your free equity is less than the required margin for your open trades.